Okay, people, so welcome to the FX Street webinar. We're going to call it Trade by Numbers. And basically it's all about back testing, statistics, knowing your edge. And we're going to talk a little bit about risk reward as well. So before we get started though, as always, we have our little disclaimer here to let you know that the content of this webinar is not investment advice and should be used purely for educational purposes only. All of the participants are advised to seek their own counsel prior to investing or entering into any trade. So everything we're doing here, trading, there's a high degree of risk and you can lose a lot of money. Okay, so as I said, anything we talk about here, the principles, theories that you can look at from an educational perspective. Trades, you really need to make your own decisions on them. Okay, are we good with that, guys? If so, we will continue. Okay. So a little bit about us, co-founder of Traders Corner, which is an educational website that I run with my brother. We've been in the markets for maybe 7-8 years now. We do a lot of writing for articles for, for FX Street, of course, amongst some other magazines and websites. And, we've been around the block for quite a while. We provide a lot of educational content. So if you like any of that, then obviously feel free to pop on over to the website. And if you like Twitter, you can follow me at Alex Ong UK. Wonderful. So we're talking about back testing here. Okay. Now, I've had a lot of debates with people in the past, good traders as well as bad traders about back testing. And there's always, many different opinions on back testing, on whether it's good or not, and, how it can be used and so on and so forth. So before I start, just want to ask the people in the room here, how many of you guys who are trading have tested their systems? We get a little yes or a no there. How many of you have actually tested your systems, have statistics on the systems that you're trading, so you know exactly what to expect from it? No one? Nope. Okay. So far, I've got one no and nobody else wants to admit to it. Yes, Richard. I know you have, because I know you're doing well. Excellent. No. Okay. Now, one of the biggest arguments that I have with people when they talk about backtesting, they say, well, you know what, you don't get the psychological impact of real trading. When you're really trading, you've got money on the line and all of that kind of stuff. That's when you really know whether you can trade a system. If you're just, trading it without any money there or nothing or something like that, then really and truly, you don't get the psychological impact, so you don't know whether or not you'll be able to make money in the market. Now that there is the key sentence, okay? You don't know whether or not you will be able to make the money. It didn't say anything about the system, okay? You're just talking about yourself. But what I want to try and get across today is that you are helping yourself learn the system. You're going to help yourself in the long run learn how to trade by backtesting. Yes, you may not have the psychological impact of real trading. Okay, so you're not going to know what it feels like when you've got money on the line and you've seen your trade go 50 points in the money, all just to come back to break even, and now you're wondering whether or not you should take your trade off the table because it's back to break even. It's already gone 50 points in one direction. If it's coming back this way, it must mean that the market's going to stop me out, and all of that kind of stuff. Yes, I completely understand you aren't going to know that, and that's fair enough. Okay, but what back testing does do is it lets you understand your system. It helps you to understand your statistical edge. Okay, and that's very, very important. I mean, from my own perspective, a couple of months ago, I think it was it just after Christmas or just before Christmas? But anyway, had a horrendous morning trading, a really, really bad morning. Literally everything I touched turned into a loss. It was amazing. I couldn't have been that accurate in my trading if I tried. Everything I entered, it went the opposite way. And I was of a good mind to literally, close up the screen, walk away for the day, and, put it all down to myself and my trading. But what I decided to do during the lunch hour is I sat there and I went back over my statistics. I went over my live statistics as well as a back-tested statistic. And I saw that mornings like this had happened in the past. They don't happen often, but it had occurred before, and therefore, it wasn't me that was the problem. It was just the markets were the problem. Sometimes that's the way it is. And I also looked through those results and I found that actually in the afternoons, for a lot of the time, you actually made some of that back. It doesn't always continue, but I knew that about this specific system. because I've got statistics on those systems. And sure enough, I traded into the afternoon and I made a lot of the money back. Okay, I didn't make all of it back, but I made some of it back. And I was true to the system because I understood what you could expect from the system. Does that make sense to you guys so far? Yes, no, maybe? Excellent. Okay. So what else do we learn from backtesting? We also learn to recognize the setups. For a lot of people here that perhaps haven't been trading for a long time or haven't spent a lot of time in front of the screen, sometimes reading a chart can be quite difficult. You've got all of these candles going in all different directions, and trying to glean the story from the charts isn't something that's easy to do. But what you can also do from backtesting is you get chart time. Okay, yes, your money isn't on the table, but that's not important. It's not important to have, 10, 15, 20 pounds a point on the table. What's important is that you learn to understand what the setup looks like in the heat of battle. So and when I'm talking about backtesting here, I'm not talking about looking at a chart and just literally just going back over a chart and not really paying too much attention and sort of just eyeballing the chart. That's not backtesting. Okay, that can give you an idea, that can help you come up with a theory for a trading system that may be profitable, but that's not backtesting. I'm talking about going bar by bar, one at a time, okay, one single bar every single time, and making the decision every time a new bar presents itself, okay? So I'll show you how we do that later. But ultimately, what I'm trying to say here is that the backtesting, if you do it properly, it gives you screen time that you wouldn't otherwise have. Okay, and screen time when you've got money on the table is not the same screen time when you're completely neutral and you don't have anything at risk. So then you can take things in. You're not thinking emotionally about the trade. You're thinking properly. You can look at the chart and you can analyze the chart properly because you don't have any money on the table. So even if the market's coming back against you, you can see that that's just a little pullback within the bigger trend, rather than if you have money on the table, well, you think, well, you know what, the market's coming back against me. It's going to have to stop me out now. Do you know what I mean? So the other thing about backtesting is it allows you to recognize the setups, to understand what your setups look like in the heat of battle. And that's very, very important. And this kind of goes hand in hand. The next one, you get to give yourself valuable chart time without risking any money. Now, the first point here we said was that you don't get the psychological impact of real trading. And sometimes that's actually a good thing. In the very, very beginning, when for some of our members that are very new to trading, we tell them literally don't even think about putting any money on the table until you can not only recognize the setups, but also execute. Get to know your broker's platform and stuff like that. Because if you can't execute, then you're going to do yourself a disservice. There's nothing worse than trying to enter a sell and you buy, or doing something ridiculous and missing the trade. When we're trading, we've got enough on our minds to think about without having to think about the actual mechanics of how we get into a trade or what the trade setup's meant to look like and all of that kind of stuff. All right. So testing without risking money on the table, I would actually say, is almost as important of doing it with money on the table, without the psychological impact. And finally, backtesting helps you to build confidence in yourself as well as your system. Okay, because we all know that for those of us that have traded and have backtested a system, there have been times in the past when you've tested the system, everything looks wonderful, you take it live, you trade into a drawdown. No one gets to choose whether they trade into a drawdown or not. It's just the markets. You have to accept it. But what you can do from backtesting is you can build confidence in the system that you're trading. So you can look back at your statistics and you can say to yourself, well, you know what? Fair enough. I hit a drawdown here. Okay, that's not a problem. I'm trading into a drawdown now. That's very similar to what's happened in the past. Therefore, I can expect in X, Y, Z trades time to start getting closer to starting to win some trades, and then building my account back up. And I know from looking at the statistics that I don't need one huge, massive trade to get all of my money back, because if I just trade the system, then slowly but surely, trade by trade, I'm then going to build my account back up and I'm going to go into positive territory. And you need that positive reinforcement when you're trading, because you do doubt yourself when you're trading, especially if you haven't been trading for very long. If you're kind of new to this, and then you can fall into that vicious circle that many, many new sort of rookie traders or struggling traders face, which is ultimately you find a system, you eyeball it, you don't test it, you just kind of go back over the charts and like, yeah, that kind of makes sense. We'll give that a go. You go into the markets, you start to lose money. You say, okay, the system's a load of rubbish. You toss it in the trash, and you go and find the next system, and then the next system, and then the next system, and the next system. Okay, and you kind of get the point, and you're in this vicious circle, which you can really never ever get out of, purely, because you don't know what to expect from the system. So as soon as you get, 3, 4, 5 trades into a drawdown, you stop trading the system and you start looking for something else, rather than understanding that the markets are not perfect. The markets are not going to give us what we want every single time. The FX markets, we need to understand that it's not just speculators in the FX markets. You've got large corporations in there, pushing loads of money through the markets, which they have nothing to do with your particular trade setup. It just may be the time that they're repatriating some of their funds, and the market goes the other way and it stops you out. Okay? So the FX market, even though we recognize patterns on the chart, it's not going to be perfect. And the sooner you guys can learn to understand that you will take losses, then the closer you will be to eventually being able to trade consistently and be able to trade profitably. Okay? So, backtesting, how do you do it? Okay, I'll put up here, do it properly. And we'll go through these points. So if you guys are interested in backtesting, and I really, really, really advise you guys to do this. If you're not profitable yet and you want to be profitable, then this really is a must for you. I don't care. You have to do it. Otherwise, at some point in time, the wheels are going to fall off with your trading system and you're going to enter that vicious cycle again. So it all starts with a theory. Okay, you can look at your charts, you decide, you go back, you spot some patterns, and you come up with some sort of a theory, whether it be, I believe the trend is my friend and I want to buy the pullbacks in the trend, or I want to buy the high highs and I want to sell the lows in a trend. Whatever it is, you need to come up with an idea that makes sense to you. Now, it doesn't matter if it doesn't make sense to anybody else, because they aren't you. Like, for example, I've got friends who like to trade the ranges. For me, I can't really do that because I'm a trend trader. I believe in the trend. I believe that the trend is going to continue. So when we're coming up to the key levels, I'm looking for a breakout and a pullback to that level, whereas others are looking for it to completely reverse at that particular level. So everybody's different. You have to come up with a theory that makes sense to you, something that you can own and you can trade. Okay, so that's the very, very first thing. Next, you need to write down your rules, because if you start backtesting, okay, without your rules written down, what you end up doing is you change your rules as you start to go along. So you'll be like, well, you know what? If I didn't get into this trade here because of this, then I wouldn't have lost that. So that's a new rule. That's something I'm going to do now. And then, that becomes a new rule. Until the next time that doesn't work out and you say to yourself, well, actually, that doesn't really work out all the time. So, that's no longer a rule. I'm going to put something else there. The problem is that in your statistics, you don't have any consistency there. In your statistics, in the numbers that you're building up, you're molding the numbers to suit yourself because you don't want to be wrong. And believe it or not, even when you're backtesting, you find it very difficult to take a loss. A lot of people do that. So you start to change the rules and bend the rules so that you don't have to take the loss, even though there's no money on the table. Go figure that. Okay, so you write down your rules. You need to be using a big enough sample size worth of trades. All right. Now that means, if you're trading a 4-hour system or something, that doesn't mean looking over a year's worth of data. That's never enough. You want to be looking over 5, 10 years worth of data. If you're trading an intraday system that trades 2 or 3 times a day, you want to be looking back on the last 6 months or a year's worth of data and more, if you can do. Right? But that is an absolute minimum. You want to build up, hundreds and hundreds, if not thousands worth of trades that you've got statistics on and you know what to expect from those trades. If you don't do that, then it doesn't really make any sense. And then your system and the numbers that you built up, they don't really tell you very much. You need to have a large enough sample size worth of trades and worth of test data to be able to draw any significant conclusions from that. All right, so use a big enough sample size. Trade at the hard right edge of the screen. What do I mean by that? What I'm going to, shall I exit this? Let me go and take you to a chart at the moment. so that I can show you exactly what I mean. I'm going to exit that. Let's go to a chart. Okay, can you guys see the chart here? Yeah, hopefully. No one? No one's in here? Yay! Okay, yes, you can see the chart. Excellent. So, what I mean by the hard right edge of the screen is that if we look at this here, it's very easy to say, okay, I would have sold there, I would have sold there, I would have sold there, I would have sold there. I probably wouldn't have sold there because that doesn't really look like much of a pattern. I wouldn't have sold there because that wasn't the start of the downtrend. And you get to, you sort of subconsciously, you make up stupid, ridiculous rules that don't make any sense. Whereas if you're trading at the hard right edge of the screen, you say to yourself, well, you know what? You're going bar by bar. So here's one bar. What would I do? Nothing. Then you can move on forward and say, would I have taken trade there? No. Would I move forward again? Hold on. Would you have taken a trade there? Probably not. How about here? Ooh, maybe. If you're not waiting for the close of the candle, then that definitely looks like something you'd probably take. So you would have to then say, okay, I'm in that trade and I've been stopped out of the trade. Whereas if you're looking at it from this perspective, you'd say, well, no, I wouldn't have got into that trade there because of X, Y, and Z. You'd make up a stupid reason for it. And, you know, miraculously, you get to wipe that losing trade out of your statistics. Now, that's not what you want when you're backtesting. You want to know exactly what to expect from your system because, you know, remember, when we're doing this backtesting, we're not trying to make ourselves right every single time. That's not the point of it. You're trying to prove or disprove your theory. All right? It's not about, if the theory doesn't work, then you've just saved yourself some money in the live market. It's not about testing a system and making it work just because it makes you feel warm and fuzzy inside. That's not how it works. You're testing it to prove or disprove the theory. Does that make sense to you guys? Go back to the presentation. Okay, so you use a big enough sample size, you trade at the hard right edge, and you collect all of the information that you possibly can about the trade, all right? And I'll show you some of the spreadsheets that we use in a second, all right? We'll come back to that in a second. Take your time, all right? There's no first places, there's no prizes for the first person to trade the markets tomorrow morning, all right? It's about understanding that this is a long-term goal, that you want to be successful in the long run. You don't want a quick lucky streak. You want to be successful in 10 years' time, in 20 years' time. You want to be able to make money doing this, okay? So take your time with it. Really, don't force it. If you don't have the time to do it, then don't enter the markets tomorrow. Wait until you've had the time to build up your statistics, to do your back testing before you get into the trade. You know, and don't go through it at 100 miles an hour. Go through it at a speed where you're able to take in all of the information, where you can look at the charts and you can go bar by bar. So you don't need to go 5 bars by 5 bars or something like that and make your decisions accordingly. And also, don't cheat. As I said before, we're doing this to prove or disprove the theory. So it doesn't make any sense for you to make up rules as you go along just to keep yourself out of the trade. That's why it's important to write down the rules at the beginning. Before you start the backtesting, write down the rules. Have the checklist. Okay, there's actually one gentleman in here today, in this room today. He's one of our members, and he came up with an amazing checklist, which he showed us at our last seminar. It's sort of like a critical path planner thing, and it literally was one question. Is the market doing X? If it's doing X, you get to go to this point. If not, then there's no trade on, look for something else. And it was sort of like, there were 15 or 20 points on this particular spreadsheet, and it was incredible. The amount of detail and the way that he'd set this out to make a decision on whether to trade or not. Now, what he's able to do from there is to take all of the emotion out of it. He's literally ticking a checklist. If the checklist finishes up positive, he takes a trade. If it doesn't, he doesn't take the trade. He moves on to the next chart. Or if that's his final chart, he walks away for the day and does nothing. And this gentleman here actually managed to take his account from, let's say, a round number to a very, very, very low number. And then he managed to trade it all the way back up to where he started and then double his account from there. Okay, and that was the difference. That was, I would probably say, and he can feel free to sit in here if he wants, I won't identify him. I'll probably say that was a turning point for him in his trading, when he went back and he started to backtest the trades and he built up proper statistics so he understood what was going on, that was a turning point for him, and that's where he managed to turn the corner and start to make profitable trades. All right, so this isn't a waste of time, guys. This is something very, very important, and I promise you it will pay you dividends in the long run. So, okay, before we go on to here, I want to come away from this again and show you an example of a spreadsheet for one of our systems that we tested. Okay, so let's get this here. Where am I? Okay, can you guys see the spreadsheet in front of you? Hopefully. Okay, so look at what we have here. This for me was enough information for this particular trading system. Some other trading systems you require more information, some you require less. Okay, so we have the date, entry time, exit time, total time you're in a trade. I quite like that measurement, because then you know what to expect. You know, if your typical trade is an hour long and you've been in the trade for 3 hours and it's doing absolutely nothing, then ultimately you know that you're no longer in a trade with a high probability of success. It's not the trade that you tested, and maybe you can come out a little bit early and save yourself some money, all right, before it hits one of your stop loss or your profit limit. So your time, win-loss. The way that I was testing this system is I was trying to make it quite mechanical, okay, because I want something we're giving to our members, and we want to make sure that it's something that it takes a lot of discretion out of the window. When you're saying place it behind the higher high, or take profit at the next resistance point, that's quite subjective. You know, it depends on the person where they view the next speed bump to be. So we did it basically on a one-to-one basis. So, you know, you lose 1%, you make 2%, so on and so forth. News before or after, sometimes that can have a bearing on your trade. If you're trading the, you know, very, very short term, that might be something you want to look into. The result, which is nice. Okay, so this is a cumulative result. So over here we've got the individual results, and here we have the build up over time. So what does that look like over time? And then over here, just some nice things just to indicate with different size accounts, with different risk parameters, what the sort of return would be. And then over here, we've got things like the strike rate, okay? Total trades, so how many won, how many lost, consecutive losing trades, consecutive winning trades. That's an important one to understand. Then we've got things here for the maximum drawdown. So what's your peak to trough drawdown? How big was it? When was it? So on and so forth. Winning days, break-even days. You know, you really want to learn to understand what to expect from the system that you're trading. Okay, then we even went a step further. Okay, because for this system here, I wanted to understand, is there a more profitable time of the day to trade? Okay, when is the most profitable time of the day to trade, if any? So this is 9, 10, 11, 1, 2, 3 o'clock, all right? And as I can see here, I've built up different statistics, and actually I found, from building these statistics, I found that if you're trading between 10 and 11, that's actually the least profitable time of trading. And you can then make a decision for yourself whether or not you want to include that in your trading results, not in your trading results, in your trading regime or not. You may say, well, you know what? If I'm only getting a 40% strike rate there, which is a little bit above break even, so to speak, then perhaps I don't want to waste my time with that. And I'll trade from 8 in the morning till 10 in the morning, and then from 1 till 4 in the afternoon. All right? Do you know what I mean? So this helps us build a picture of what to expect from our system, of how to trade it. Now you'll notice here, I've got this as the theory tab. So this was just basically coming up with a basic theory of, could this work in the markets? Okay, I hadn't optimized it. I hadn't thought about other things like bringing support and resistance into play and stuff like that. I just thought purely from a mechanical perspective, can this work? And if it can work, then let's see what we can do to make it a better system. Now, I'm not trying to eliminate all of the losses, but I'm just trying to bring in some of the technical analysis tools which I know worked, which, you know, I truly believe in. So then we go to these tabs here. So 2011, 2012, build up similar statistics. Okay, so we've got, as we can see here, the 10 o'clock trading is really, really bad. So sometimes you may decide, you know what, trading at 10 o'clock, I proved it twice now, it doesn't really make too much sense. You might eliminate that. By the same token, you can see trading from 3 to 4, you get a 75% strike rate, which isn't bad at all. You come up to the top here again. So 2011, and this is using support and resistance here. We get to push the strike rate up a little bit there. So going from like a 51, 52%, you can then, you're using support and resistance for 2011, you then push that up to sort of like a 55, 56% strike rate, which does make a difference. And then we go down to 2012 and do this thing, and we can see that, okay, so push the strike rate up a little bit more simply by using support and resistance, from only trading from support and resistance and pivot points. Then if we go down to this here, we can actually see, oh, well, in 2011, there was only a 34% strike rate at 10 o'clock onwards, whereas in 2012 so far, actually, that's not been half bad. So, you know, you can then make a decision for yourselves, again, whether or not you want to be able to, whether you want to trade at that time or not trade at that time, or trade at a different time. But what I'm trying to show you guys here is that you need to know all of this information so that you can then decide for yourself what you want to do, how you want to play it. And then we came up with a further theory of saying, okay, if we did use more, you know, subjective stop losses, swing points and all of that, what would that mean to the system? And you can see it brings the strike rate down a little bit there. But then we also we looked at doing a risk reward of going from 2 to 1 to what about a 1.5 to 1, or what about a 1 to 1? What does all of this mean? What does this mean for our trading systems? And that's going to bring me on to our next topic of the conversation in a second, which is risk reward. But as you can see here, we've got a lot of information on all of our trades. And another nice piece of information, like a casino, is that I know my statistic, profit per trade is roughly 0.5%. Okay? So every trade that I take, win or loss, over a large enough sample size of trades, is 0.5. If I go down to 1.5 to 1, it's 0.49. If I go down to 1 to 1, it's 0.45. But this is all information that's good for me to understand. So when I'm trading, if ever I have an issue, I can go back at these results and I can look at them and I can take comfort in these results. And then finally, you know, we build graphs on them so that we can take a look at the equity curves of some of these systems. And we can see, you know, for example, the 1 to 1 is pretty much almost a straight line. You get very, very few drawdowns. The drawdowns that you do get is more sort of sideways actions rather than anything really going against you. Whereas if you go for the 1.5 to 1, you see that you get steeper jumps, but you do get steeper troughs as well. And then you go to the 2 to 1, you can see that you get massive jumps followed by a little bit of activity, followed by a massive jump again, little bit of activity, pullback, massive jump, and the pullbacks are a little bit more aggressive. And you can look at this and then you can make a decision for yourself which one suits you more. Okay, which actually brings me on to the next part, the final part of the presentation, which is, if I get the camera up here, risk reward, a positive risk reward. All right, now generally, I know from testing that I've done, a more positive risk reward generally tends to be more profitable in theory. Okay, the problem with a bigger risk reward, so let's say, for example, a 2 to 1 versus a 1 to 1 or 1.5 to 1, is that if you can't trade like a machine, if you can't follow your system very, very strictly, then as soon as you start to hit a drawdown, you're going to start to do silly things. You're going to not take the next trade, or, you know, get in a little bit late and just do generally stupid things. All right. So even though a 2 to 1 risk reward is more profitable, in actual fact, for you as a person, you may require that the market tells you that you're right more often. You may enjoy being right more than you enjoy being profitable. Okay, and what I mean is, I'm not saying that you like to lose money, but you might be one of those people that would be happier making 20% a year, being right 80% of the time, rather than 50% a year, being right 40% of the time. Okay, you've got to decide who you are as a person. So, as I said, in theory, risk reward, a larger risk reward, does tend to come out and give you more money at the end of the day. But in practice, most traders cannot handle a big drawdown. Most traders, you know, if you're trading, let's say 1% of your account, and you've had 10 losing trades in a row, which is more likely to happen trading a larger risk reward than it is a smaller risk reward, and then you won't take the next trade, that's going to screw with your system. That's going to mess you up. If you can't take those 10 trades in a row and then take the 11th without even blinking, then perhaps that sort of a system isn't right for you. So maybe don't go for bigger profit targets, but just go for more consistency. This is something that you need to be able to make the decision for yourself. And then if you manage to get consistent, okay, then maybe you don't just take a 1% risk on a trade anymore. Maybe if you're right 80% of the time, you can actually afford to take a 2% risk. So then, whereas you were more profitable trading on a 2-to-1 risk reward type scenario, in theory, but in practice, you can't trade according to those rules. So the theory is you make more like that, but in actual fact, if you're more consistent going for the 1-to-1s or the 1.5-to-1s, you can actually up your stake size a little bit and hence make just as much as you would have been making on a 2-to-1 risk reward, just purely for the fact you're taking a bigger position size than you would be on a system that makes you wrong more times than you're right. Does that make sense to you guys? Sorry, I know I've been talking at you for all of this session here, but I just want to get all of that information out there. And that actually brings us to the end of the slide. So what we can do now is I can then open up the session for you guys to ask your questions. So Boyke, you have a question. Can you say something about forward testing? In what respects, Boyke? What would you like to hear about? I mean, ultimately speaking, forward testing, again, is something that you need to build into. From my personal opinion, okay, let's say, for example, you've got £10,000 that's your trading bank. I would suggest to you, whilst you're in the testing phase, you only trade maybe £1,000 of that. So you open up a micro account or something, and you just get used to the mechanics of entering the trades in real time and dealing with the trades in real time. Okay? And then once you've done that, once you prove you can be successful at that, then start to build into your position sizes. One thing I'd never advise anybody to do is to flat hit the ground on your max position size with a new system, because you don't know how you react to it. You don't know how you trade it in real time, and hence, you could trade your account away just by making silly mistakes. So I would definitely recommend that forward testing, you trade a fraction of your account, and also you segregate the accounts. Okay, so if you're testing, have like a testing account. Don't mix up your testing account with your actual trading account. And the reason for that is you need to know what numbers relate to what. And if you've got 4 or 5 different systems running in one account and you're trying to test another one, it's going to be very difficult for you to know which ones were the winners from which system, which ones were the losers. Okay, so try and have separate accounts to be able to do that. Do I use a program called Forex Test and Backtesting? I have used it, Manoj. I have done in the past. Currently, I don't. And that's just for the fact that I use NinjaTrader a hell of a lot now. And I find just going forward bar by bar actually helps me as well. Literally having to write things down, it sort of drills into your head the system a bit more. Any other questions, guys? Oh, GY, sorry, I saw a question up there. So yes, Boyke. Do I record these end of day since the market has moved? Yeah, you would put it at the end of the day. If you've got time during the day, then feel free to do it. But if the markets are moving quickly, your main focus is on trading profitably. I fly planes, so I've got a private pilot's license here in the UK, and we have a saying when we fly, which is aviate, navigate, communicate, which ultimately is, fly the plane first. Whatever you do, make sure you fly the plane. Everything else is secondary. Fly the plane safely first. So when you're trading, trade first. Once you've finished your trading and you've got some spare time, then you can look at doing other things. But your very, very, very first thing is to trade the market. Excellent, Richard. Richard did all of his system development on FX Tester, and I know that he's really, really doing well now. Can backtesting be affected by news and data? Well, I mean, the markets are affected by news and data, so yeah, of course, it can be if you decide to take those into account. You need to be realistic. Sometimes you may get an opportunity which looks like it's a beautiful move, but you need to look at the timestamps, particularly of range bars, because with a range bar, you might get 20 pips happen in about 2 seconds. And then you need to be realistic and say, well, you know what? I never would have been in that trade. There wasn't enough time for me to click my broker to accept. So you need to just kind of toss that one to the side and say, actually, you know what? That didn't make any sense, so I wouldn't have taken that. It's better in the long term, but I always find it takes counter trend reversals just where I'm wired. I'm profitable, so do you recommend sticking with this way or trading? No. If you're profitable, Manoy, trade the way that you trade. I'm just saying, for me personally, I prefer trading with the trend. It's just what works for me. I believe in it better, and that's the way that I'm able to make money. If you're profitable trading against the trend, then please, you stick to what you're doing. Okay? If it's not broken, really don't fix it. All right? If you want to entertain yourself, then, take up squash or something like that. But don't change your trading system just because, you feel like something else should be better. If you're making money in the markets, then you're doing better than 90 to 95% of all other participants in the long run in this market. So stick to what you're doing. Yeah, exactly, Richard. The secret, once you're live trading, is to be able to trade with the same lack of emotion as you do in your back testing. Boyke, I can sort of tell you from my perspective, I've spoken to Richard a lot in the past. He's one of our members, and yeah, he's very emotionless. He's got a system in place which allows him to literally, follow a plan and either trade or not and walk away. Exactly, Zetolos. It accepts your losses. Everybody's going to take losses. I wish there was some secret. I wish there was something I could do to take away all of your losses, but in reality, I cannot do that. So, you need to accept a loss. And I think really for a lot of traders, once you learn to accept the loss and to not worry about the trade, that's when you'll start to turn the corner. Forex tester GY. If you do a Google on Forex tester, it will come up there. It was probably like one of the first two websites that come up. Any other questions, guys, at all? How many hours do I sleep a day? Not very many, actually. Maybe 4, 5. So that's just something, if you ask my mother, as a child, as a baby, I think I slept maybe 1 hour a day and screamed for the other 23. So you can stay up to 48 hours a day. That's fantastic. And that's why I'm all few minutes a day in FX. Okay. Yeah, exactly, Manoy. When you're trading, it's not about the next trade. You can't control the outcome of the very next trade. The best thing that you can do is to understand that this is a long-term game. Okay, it's not about the next trade. It's about the next 20, 50, 100 trades. Okay, so that's a very useful piece of advice there for everybody on this trip, on this call here. Manoy just said that it seems to me that once your strategy is in place, you must commit to taking the next 20 plus trades and not just focus on any one particular one. And that is a fantastic insight there. Okay, fair enough, Zetolos. That's not a problem then, not at all. Any other questions? No. Okay, so how many of you guys here are actually going to leave this call and do some testing? Be honest. I'm hoping for 95% so that we can change that statistic and roll it on its head. Okay, guys. Well, thank you everybody for attending this webinar. We're going to be doing, I think it's 1 a week now with FX Street. So we'll try and change up the content and everything. We'll do a couple of live trading sessions, stuff like that. Alex, do you know where one can get mentoring on the psychological, like taking losses, etc.? I mean, any good educator or mentor should focus on the psychological aspect. So you can see a shrink or something like that if you like, but anybody that's been in the game should be able to help you with that. Feel free to drop me an email if you want to talk about this in any more depth. I'll be happy to chat with you over email about it and see if we can come up with a plan for you or something. So yeah, we're going to be doing one a week now with FX Street. So as I said, we'll change it up a bit. We'll have different subjects. We'll do some live trading. We'll do all of that stuff, and hopefully we'll get you guys to the point where you're making some money consistently. Sound like a plan? Excellent. Okay, guys, take care, and I look forward to speaking to you all very, very soon. Thank you.